So guys, despite the market being at all-time highs, there are actually still a lot of discounted dividend stocks out there. And today we'll be looking at 3 of them, all of which look like great pickups for your portfolio as we fly into July. But real quick, before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. So guys, as a Las Vegas local, I feel very fortunate to live just like 20 minutes from the Strip, which, people travel from all over the world to visit. Although I really don't go down there too often, maybe once or twice a month at most, one of my favorite things to do is just walk up and down the Strip. And I think I'm unlike a lot of other locals in the sense that the Strip's novelty hasn't really worn off for me yet. I think it's amazing to be so close to legendary places like Caesar's Palace, the Venetian, and the Mirage, which is actually closing next month to become the Hard Rock. But interestingly, and a lot of people don't know this, but these iconic spots, along with other major properties like MGM Grand, Mandalay Bay, New York, Excalibur, and the Luxor, are all owned by one company, and that's Vici Properties, which is one of the world's largest experiential real estate companies with a portfolio of unique assets in the top gaming, hospitality, entertainment, and leisure destinations like Las Vegas. Now, if we jump over to Seeking Alpha, we can see that 2024 has not been kind to Vici's share price. Just in the last month, this company is down almost 6%, which is going to leave them with a year-to-date drop of nearly 12%, and they're really not too far off there from their 52-week low. While this performance is pretty poor at first glance, I think this presents a great buying opportunity for investors who are looking for cash-flowing assets at discounted prices. And fortunately, in Vici's case, this decline in share price is driven more so by the high interest rate environment we're in rather than any serious issues within the company itself. You see, real estate investment trusts like Vici Properties will take on debt and borrow money to buy more properties, which is how they grow. But when interest rates go up and stay up for longer, like what we're experiencing now, it makes borrowing money more expensive, which cuts into a REIT's profitability because it'll have to pay more in interest expenses, and this puts downward pressure on the share price. In Vici's case, though, the dividend is still very well covered with a 66.5% payout ratio, and the rest of the stats look really good as well. The forward yield is coming in at 5.91%, which is about 1% higher than the 4-year average yield, and the 5-year dividend growth rate is also looking really good at 7.6%. So between that high yield and the 5-year growth rate, Vici Properties is looking like double trouble in the dividend department. Alright guys, now this second stock, LVMH, is one that I've actually never talked about before here on the channel, and I'm not really sure why that is because it's such an iconic company and it owns some of the world's greatest brands across several key segments in the luxury goods market. In fashion, LVMH has brands like Louis Vuitton, Christian Dior, Fendi, Givenchy, and Marc Jacobs. In wines and spirits, they have Moet and Chandon, Veuve Clicquot, I hope I'm pronouncing that right, Belvedere, Dom Perignon, and Hennessy. In watches and jewelry, they own Tag Heuer, which is one of the most iconic watch brands. Steve McQueen used to wear the Tag Heuer Monaco. It's one of the most famous watches out there. But anyway, also in this segment, they own Tiffany & Company, another very iconic company, Bulgari, Hublot, and Zenith, which I think is a pretty underrated watch brand. And all that barely scratches the surface. I mean, as you can see from the rest of this chart here, there's just so much more going on with this company. They're an absolute behemoth. With that said, the share price has certainly not reflected that lately. I mean, just in the last month, LVMH is down about 8.25%, so that's quite a big drop there, which is going to leave them with a year-to-date decline of about 5.6%. And just like with the last stock, LVMH is somewhat close to their 52-week low. And I didn't see any company-specific news that would explain this drop in share price, but a couple weeks ago, an election was announced in France where LVMH is based, and the timing of this announcement lines up perfectly with the drop in share price. Now, I'm speculating here, but the share price might have dropped because investors are concerned about any changes that might come out of this election. Elections have a tendency to potentially shake things up, so there could be some economic changes or other things that could come out of this that might have an impact on a big company like LVMH. At the very least, it's causing some uncertainty, and I think this uncertainty is what's causing investors to pull back a little bit, and I think that's maybe why we're seeing the share price go down. But with that, in the meantime, the dividend yield has been pushed up quite a bit from this drop in share price. We can see that right now it's sitting at about 2.1%, which is about 34.5% above the company's 5-year average yield. On average, over these last 5 years, it usually hovers differs between 1.5 to 1.6%. And looking at the rest of the stats, LVMH is your classic dividend growth stock. So they've got that low-ish starting yield, but the 5-year dividend growth rate more than makes up for that at 16.64%, and they have a 3-year dividend growth streak. And looking at the dividend growth chart over the last decade, we can see it's had its ups and downs, with certainly more ups than downs over the years. But with this company, it's important to keep in mind that it is a European-based company, and they typically have different dividend policies than what we're used to here in the United States. Their dividend policies may be a bit more loosey-goosey as opposed to here in the States, where if you're paying a dividend, the intent is that you will continue to grow that dividend year after year after year, like we see with the dividend aristocrats and the dividend kings. But it's not uncommon to see some of these European companies go with a different approach. The important thing is, though, that over time, the dividend per share is trending up. So that's really the important thing at the end of the day. Anyway, guys, this third stock is one that definitely needs no introduction, and we actually talked about the Hershey Company a handful of months ago in one of these videos, but since then, it's dropped even more, which makes it an even better buy today than it was the last time we talked about it, so I thought it might be worth revisiting. Jumping over to Seeking Alpha, in the last month, the Hershey Company is down a whopping 12.8%, so a very steep decline for the Hershey Company, which is going to leave them with a year-to-date loss, which is not nearly as bad, 2.33%, but if we zoom out to the last year, they're down close to 30%, and we can see they are right there at their 52-week low. Now, throughout much of this past year, Hershey was negatively impacted by rising cocoa prices, and as we can see here, cocoa prices absolutely soared, which hurt Hershey's profitability. Now, while prices started to decrease, they did begin to climb up again towards the end of May and into June, and I think this recent rise again of cocoa prices certainly was a catalyst, maybe not the only one, but a catalyst of Hershey's drop in share price this last month. But anyway, with this drop in share price, the dividend yield is sitting nice at high, just over 3%, which is 45.4% above the company's 5-year average yield, which is coming in at about 2%. So you'd be getting a 1% greater cash flow return buying Hershey today at current prices compared to, what's been going on average these last 5 years, which I think is great. And it gets even better when paired with the rest of these dividend stats. I mean, the payout ratio is coming in pretty moderate, 50%, so that dividend is still very well covered, and the 5-year growth rate looks great too, double digits, 12.15%, and they have a really nice dividend growth streak of 14 years. Overall, guys, I think the best case scenario is playing out right now for investors who might be interested in swooping up some more shares of any of these 3 companies, and I think they're all great companies to consider. With that, though, these aren't the only ones. There are still so many discounted stocks out there that I think you need to keep your eye on. The first of which is going to be AGCO. In the last month, this company's seen a pretty big drop of near 8%, and year-to-date, AGCO is down almost 15%, and they're at their 52-week low. Moving on, AWR, American States Water Company, which is a dividend king in the utility sector, is another one to keep your eye on, guys. You can see they're down quite a bit in the last month, down about 9%, which leaves them with a year-to-date loss of 12%. Moving on, the third stock to definitely keep your eye on is Bristol Myers Squibb. In the last month, they're not seeing too crazy of a loss, down almost 2.5%, but year-to-date, BMY is down 18.3%, and if we zoom out to the last year, this company is down 36%, and they're right there at their 52-week low. This company just can't catch a break. But anyway, moving on to stock number 4, definitely keep your eye on Dollar General, who's seen a pretty big drop in the last month. They're down 11%, which leaves them with a year-to-date loss of about 5.3%. And then moving on, another one to keep an eye on is Hormel Foods, which is actually another dividend king, but Hormel's down quite a bit in the last month, down 16.5%. We can see that they really jumped off a cliff right here. Looks like they lost about 10% in share price just in one day, but this is going to leave them with a year-to-date loss of about 4.6%. And then jumping over to another dividend king here, Johnson & Johnson, definitely one to keep your eye on, sub $150 per share, but in the last month, J&J is down another 2%. Year-to-date, J&J is down 5.1%, and if we zoom out once more over the last year, this dividend king is down at 9.25%. And then, guys, McDonald's is actually another one to keep your eye on for sure. In the last month, this company's down 3.1%, which is going to leave them with a pretty substantial year-to-date decline of 12.5%, and over the last year, McDonald's is down also about 12%, so I definitely think this one's getting interesting. And then moving on, guys, Old Dominion Freight Line, ODFL. This is a stock that we talked about in last month's video, actually, but I still think this is one to keep your eye on. In the last 30 days, this company's down another 1.65%, which is going to leave them with a year-to-date loss of 13.7%, and they're really not too far off there from their 52-week low. But anyway, guys, the 9th stock that I think you need to keep your eye on is going to be Pepsi. Just in the last month, Pepsi's down 7.7%, which is going to leave them with a year-to-date loss. It's not too crazy. They're only down 1.5% so far in in 2024. But if we zoom out once more, looking at the last year, Pepsi's down almost 10%. So I think this one's interesting right now. Anyway, stock number 10, guys, is going to be one of my favorite companies. Definitely keep your eye on Starbucks, who's seen a little bit of a rebound in the last month. They're up 2.6%, but year to date, Starbucks is still down 16.8%. So guys, I'm still buying this one every week. I'll probably continue to buy it while it's at current share prices. So I definitely think this one's interesting right now. But anyway, moving on to the next stock, keep your eye on United Health Group, who's down about 7.6% in the last month. So a pretty steady decline there. And then year to date, this is going to leave them with an 8.3% decline. So this one's kind of interesting right now. And then sticking to the healthcare sector, keep your eye on Zoetis, my friends. In the last month, ZTS is down about 2.25%, which is going to leave them with a year-to-date loss, still down quite a bit, down 13.3%. Now, those are all of the stocks that I think are ones to watch right now, but in this next video right over here, I'm telling you about 3 more that are the exact opposite. These stocks over here are trouble, and you would definitely regret buying them. So click right over here to find out which ones they are, and I'll see you in the next one.